A well trading strategy is as good as the person pulling the trigger. So the strategy alone isn't what makes people profitable, it's their approach, how they take that strategy. The simpler you keep the strategy and your approach, the better it will be in terms of when you should and shouldn't be taking the trade. So in today's video, I'm gonna show you guys how to take a strategy, build an approach around that strategy to make it as simple and as effective as possible. Let's get into it. Now, before we jump into the approach part, first, let's understand what the term trading strategy actually means. A lot of traders don't fully understand the actual meaning behind that term. Now, most people get some part of that strategy aspect correct, which is it tells you where you should be entering, where your stop loss should be, but that's not enough to have a perfect trading strategy. You have to have 4 components that make up that strategy. And these 4 key points is what most traders overlook in terms of when they're looking at a strategy and adding it onto their daily trading setup. So the first step is going to be to fully understand the core breakdown of each strategy. So for example, we'll take the 15-minute opening range break as an example for today's video. Now, towards the end of the video, I'll also put that in perspective with a trade that we took a couple of weeks ago, and I'll show you guys why we took that trade. So a 15-minute opening range breakout is a strategy that takes the first 15 minutes of the open into account. You draw the high, you draw the low of that 15-minute candle, and you're supposed to take the trade once price breaks either above or below those key levels, right? Very simple. Now, some of the core definition of how to trade that is you need to have volume, right? You need to have a bias in terms of which direction is stronger. You are looking at price in terms of closing above or below that key level. These are just a few things that you need to understand about that particular strategy to have the best execution. It's going to provide you with a stop loss, an entry point, which overall is very, very simple to follow. This is not one of those crazy complex trading strategies. Now, this alone, in my opinion, isn't going to be considered a strategy, because there's a lot of things that traders tend to miss out on. And those are the 4 core things that I mentioned earlier on. So let's break those 4 things down. The first one is going to be a structured plan, which majority of these strategies do provide, such as what you're looking for in terms of the price action, what it needs to do in order for you to have an entry point and a stop loss. Very simple. The other 3 points are crucial to every single strategy, right? And this is where your personal effect as a trader comes into that strategy, right? Which is going to be different for every single person out there. Second thing is going to be conditions based on that strategy, such as how should the market bias be? Are there any patterns that you're looking at within that strategy to give you high conviction rate? What should be the volume at? Are there any indicators that can help you add on to making a better decision in terms of which direction to go with? Third, and the most important, risk management. Right? What should be your position size? Now, this has very little to do with the strategy itself and has more to do with the trader who's sitting behind the screen. I'll give you an example. One thing that I struggle with as a trader is when I have back-to-back green days, I tend to oversize, take stupid trades, and I tend to give my profits back. Now, how do I tackle that? Right? Even though a strategy has a high win rate, how do I avoid getting into an over-trading cycle? I start sizing down. So when I'm on a streak, the 3rd, 4th, 5th, whatever day, I realized that, all right, I'm about to do something stupid based on my historical pattern. This is where I need to start sizing down. So what I do on the 3rd or 4th day is I size down. Very simple. It's the same strategy, same setup, but because I have less confidence in myself, I'm going to size down. If I'm wrong, I give less profits back, because typically when you're on a high, when you're constantly making those returns, you are going to make mistakes because you're going to overlook things and think that you know better than everyone else, you know better than the market, and this is where most people mess up. So that's very important part of every single strategy. And the 4th thing that ties a perfect strategy together is going to be how consistently that particular strategy, when you bind all these things together, is providing you with profits. That's going to be key. If you have a very, very low win rate using that strategy, then that means there's something you're doing wrong. Now, when you put all those 4 things together, that is where you get a perfect strategy for the person who is sitting behind the computer screen pulling the trigger. Watching a YouTube video, me telling you this is my strategy and this is what you have to do, it might not work for you. That's why there's no golden strategy out there, right? Everybody makes changes to their strategy that suits them the best. And this is one of the best and easiest ways to find a strategy that works for you, right? You go through those 4 core things. First, what is the definition of that strategy? What are the conditions? What is my risk management? What is my risk management? Can this provide me with consistency and profitability? Usually, if you take 2 to 3 weeks of trades, you'll be able to find out how consistently you're getting returns on that strategy. Now, once you have all of this together, this is where you have an edge over a lot of other people. And I'm going to explain how. It's very, very simple, yet a lot of people overlook it. Most people don't even know where to look for in terms of a strategy, right? When they're looking at the pre-market high, pre-market low break, bull flag breakouts, they tend to miss all those 4 components. And all they do is they look for the price to move a certain pattern, and then they just go after the trade. Every pattern needs conditions, confirmations, conviction in order for that to work out. If you're not following through those rules, the chances are you're just gambling. So we're gonna take this opening range breakout strategy and we're gonna put it into perspective on how you can find edge within that strategy. Pretty much this is what I do. This is how majority of the trades that I take, this is what I look for, because once I understand what I'm looking for on the chart, I'm able to make better decisions in terms of making early entries. And that's what you guys are going to be getting out of this video. How to get early entries from a trading strategy the most simplest possible way. Let's get into it. So this is a Tesla's chart, all right, 5 minutes Tesla's chart from a couple of days ago. And you guys can see this is on demand. So if you're not familiar with what on demand is, this allows you to go back in time and pretty much replay a certain day in the market. Now this is only available on Schwab or Thinkorswim, but I'm pretty sure TradingView has it as well. The only difference between TradingView and Thinkorswim is here you can actually place a trade. All right, so let's break this down. Now keep in mind, we're only focusing on the 15-minute opening range setup. So the first thing we want to remember is drawing those high and low, right? First, let's define what that strategy is. So the strategy is you define the high and low within the first 15 minutes. So 3 candles have passed. We have a high and a low within that 15-minute range, which means now what most traders look for in terms of taking a trade, in terms of their confirmation, is going to be we need a close outside of these 2 levels. This is where we go long, and here is where we're going to go short. Very, very simple, right? Obviously, you want to make sure that volume is supporting that move. Now, this is the definition of opening range break in terms of when you're looking at a chart, okay? Now that we've understood, right, what it is that we need for this strategy to work out, how do we find an earlier entry within this particular strategy? So the first thing you want to do is you want to look for a key level, an intraday key level. All right, so that intraday key level that we have for this particular day is going to be around 334, right? So we had the opening candle reject, we had the second candle reject that level, we went all the way as high as 336 and change, we rejected that level as well. So we know that there are a lot of sellers that are very aggressive above this 334 level, right? So if we can get this candle above 334, that would give us a confirmation that we have a chance at breaking out of that 15-minute opening range. Now, this is your window for an early trade, right? Rather than waiting where everyone else is jumping in after that break of key level, we're looking for a window of opportunity somewhere here, right? Because this is where we've had multiple rejections. What we're looking for is if we get above 334 and our volume, right? So I'm just gonna draw this out here to give you guys some perspective. Looks very similar or higher, right? The keyword is similar or higher than the previous candle. It has a very high chance of continuing, right? So now we figured out our early entry. The second thing, which is, or maybe this should be the first thing because a lot of traders tend to overlook this, is going to be where are we going to place our stop, right? So typically what I do is I place my stop below that previous candle, all right? So if we're getting above 334, our stop is going to be roughly a little bit below 332, so around 331.80 based on this candle is going to be our stop. So this is now kind of telling us, all right, the strategy is we're supposed to take the trade above the break of range, right? But we want to get in earlier where people are jumping in. We want to be either scaling out or just managing the trade. So how do we do that? By breaking down that strategy and breaking down where exactly where there might be a window of opportunity, which is going to be within this purple area, right? So with the purple area being our entry and the red line being our stop, that's pretty much what we're gonna wait for. As long as the volume increases, we get above that, starting stop loss is gonna be a little bit below 332. So let's play this out and see how this pretty much goes. Now, there are a couple of other things that can help you. Right now, we're just focusing on price and volume, but there are a couple of other things that can give you a much better edge than other people, which is going to be something called level 2 in time and sales. I'm not gonna jump into it in this video, but this is something that can definitely show you if there are more buyers or more sellers, right? So you guys see now, we are within, it's been 2 minutes. So if you guys take a look right here, let me highlight it. All right, let's break down what we see. Obviously, I'm pausing this so we have more time to kind of break everything down. You have 2 minutes of this candle forming, right? It's 9:42. Within 2 minutes, volume comparatively from the previous candle, right, is, I would say 50 to 60%, right? Almost, which means we still have 3 minutes left for this candle to close, which means volume has enough time to actually get closer to what we're looking for, right? So if we were to take the trade here, our stop loss is going to be that same level I mentioned earlier. This is going to be our stop. So what I'll do is I'll highlight that. That way we know where our stop is, just for the argument of this trade. So now let's say this is our entry point, right? And I'll highlight this in purple, and we will add notes just to kind of, okay, so this is going to be our entry point, and our stop is going to be the red line. Now, there's one thing about options which helps us in terms of these early entries, which is going to be those premium spikes. Now, if you're not familiar with options, options are contracts for shares. Like for example, Tesla, it's $335. Now, in order for me to trade Tesla, I would need $335 to buy 1 share. If you risk the same $335, you can actually control 100 shares of Tesla as a contract, okay? What happens with these contracts when you have these aggressive breakouts with momentum, this is where premiums usually spike. So let's say if you get in at $1.50, premiums can spike 10 to 20% more aggressively because there's a lot of people jumping in. Because the window of opportunity for a lot of people who are not looking at early entries is somewhere above that yellow line. This is where most of the people are jumping in. So if you can find an earlier entry within any strategy, the way I'm showing you guys here, right? If, for example, if this fails here, based on my stop loss, based on my entry, let's just say it fails at 338, you still have enough time to close that trade out either with a break even or without taking a big loss. So going back to this, right, you guys see so far we're holding up well above our stop. So here's the second thing that I usually do, right? I increase my stop the moment we start to see or close above a level. So the moment we take over this 338, we're gonna pretty much leave our entry point. We're pretty much gonna leave our entry point so you guys can remember where we got in. Our stop loss is going to be this red line, right? So if you take it from whatever your initial stop was and you increase it to the next level. So here we're gonna increase it to wherever our entry point was, roughly around there. So that means if we're wrong, right, now we're protected in terms of, all right, this fails, it comes back, retest the same level, and you get in $1.50, you'll probably lose 5 cents or break even, and you're out of that trade, right? Works out very, very well. Now, I'm just gonna fast forward, otherwise we're gonna be here pretty much all day. So let's go to 10 a.m., okay? So now, as it's breaking out, right, now we take our stop from here, increase it to that opening range. Now, this is obviously something we should have done around this candle. So, but I'm just kind of following through to show you guys exactly how you want to increase your stop. You take that same stop, increase it again over 340 because that is a psychological key level. Now, this is, purple line is your entry point, right? The yellow line is the opening range breaks. Most people are jumping in either at the break and retest or right at the break. You have an edge over majority of those people simply by exploiting that strategy, and rather than here, you're jumping in here. That can give you a 20 to 30% boost on your returns just by having a better entry point. Your entries are going to play a crucial role in how much of a return you're actually going to get. Now, once you start, increasing your stop, I usually like to scale out. And as I scale out, what I do is I just keep increasing my stop loss. And as I'm increasing my stop loss, that helps me hold my winning trades longer and longer, right? So your entry here, you scale out maybe once at the breakout, second time you scale out again somewhere here, and then you're increasing your stop, which means now you can hold your runners for a much longer time. That's all. There's no crazy indicator, there's no algo, there's nothing like that I'm using that's generating those returns. It's a very simple strategy, and I'm just looking for confirmations to get in earlier. As simple as that. Now, I have done a video in the past that goes over how to properly scale out and few trade examples that you guys can go and watch on my YouTube channel. If you guys have any suggestions on what type of videos I should do, let me know. I'll do that video next. This video was very, very highly requested by a lot of you guys on my Instagram. So I had to break this down because this is pretty much what I did the last 2 days. And I've generated over $55,000 in profit in just 2 days. And there's no crazy position size either. You get in, you take the trade, and pretty much just scale out and hold your runners once you're comfortable in that position. That's it. And that runners can sometimes generate you 100 to 200%, which sounds crazy, but it's very hard to hold for that long period of time with a big position. So it's much easier as you're scaling out, taking some profits off, calming yourself down so you can hold the remaining position. So comment below what are the videos you guys would like for me to do, and I'll see you guys in the next video.